Welcome everyone to today's Portfolio Builder webinar, and we've got our announcements for the webinar fixed. We have a much bigger crowd today. I'd like to welcome, and if I mispronounce your name, I apologize. And I have unmuted everyone. If you want to mute yourself, if you have to speak to anyone outside of the webinar, you can control that. And so we have Atul, Gary, Jeff, John, Rodal. I think I got that last one wrong, but welcome everyone. We'll start off with a quick overview of the trade alert once again, and then we'll jump into a Q&A. And Gary, I pulled up your spreadsheet. I actually updated your template. I noticed you had one of our previous templates that didn't have the basic gold diamond in it. So I'll pull that up if you don't mind, and I can kind of play around with how someone would get started from scratch today as a demo.
Great.
Is that okay with you, Gary?
Patient with hypertension, diabetes, and dyslipidemia for follow-up. Period. Overall, he's doing well. Period. He now moved to Herndon, Virginia. Period. He continues to have intermittent stress-related issues. Period. Medications were reviewed with him in detail. Period. He knows that he has a borderline diabetes.
Sounds like Atul is a doctor, so I put him on mute till he's back. I think he's talking to a client. All right, well, moving forward. Gary, you got your audio today?
Yeah, I do. By the way, it's Jerry again.
Jerry, oh man, my bad.
That's okay. You'll get it, buddy.
All right, well, hey, third time will hopefully be the charm, right?
Okay.
Jeff, how are you doing today? Maybe he doesn't have his audio. Let's see what we got here. So you have two ways to communicate with me. If you like to be quiet and write your questions, I have that open the whole time. And if you like to chat, we love to chat. So the more we get everybody speaking to each other, the better. So let's review today's trade alert. Today was one of those instances where the fellow we sold our covered call to did well, and so did we. So I kind of make the reference to being the blackjack dealer, and the gambler gets lucky, hits 21, you're probably going to get a nice tip. He made more money, but we still did fine. And our general strategy is to simply write the covered call, collect around $100 per 100 shares of the SPY ETF, and try to do this 3 times a week. So we do it Monday, Wednesday, Friday at 11 Eastern. If you do that 156 times a year, you're looking at $15,600 a year of income just from the covered call. And so that's what the top of the trade alert illustrates. And if you do compound your profits, you can get a potentially greater gain. Now, I do want to preface this with we're not actually trying to get that high of a return. I'll be happy if we get half of that return, because our primary goal is to protect our capital. And so there will be times where we'll take a trade that pushes our odds of winning up towards the 70 to 90% range and allows us to make money in an up, flat, or down environment. And so we'll talk about why it's so important to be defensive when we're entering into retirement. And now we need to really think about protecting our capital and trying to make steady income. Oh, we got Mark in here. Hey, Mark, how's it going? You got your audio on today, Mark?
Do you hear me?
Yes, sir.
Oh, yeah, I'm doing great. I was just typing you back. Great.
Nice. Yeah, you missed the last few webinars. I was wondering if you're all right over there.
You know, I sometimes have a problem trying to find the link and getting in. I don't know why, but
it was our fault. We had a few issues with the webinar schedule, so now it's all clear, and you should have an easy time.
Oh, beautiful.
Okay, so let's take a look at the trade alert. So, you know, it looks like we took a loss on the covered call. And so if we look at the spreadsheet, you'll see it was a 65% loss on the covered call. We collected, I believe it was $94 on entering that. And we had to pay back $1.54 to close the position. So why would we do that? And if we do scroll down, we can see from the previous day our return on investment and profit has grown. And so the short answer is our underlying asset, the S&P 500, increased in value at a greater amount compared to the loss on the covered call. So it's really important for everyone to understand, if the market goes up, we cannot lose. We'll never lose in that type of environment. So the new trade alert today is looking at the short-term bets in the market. You can see while last trade we were bullish, predicting a small up move, today we've gone slightly under the trading price. And you can see that the market is betting in a flat to down direction. We can see there is much more volume in the put options expiring in 2 days relative to the call options. So that's not always going to be the holy grail to where we pick our strike price, but it does alleviate a lot of the confusion and makes our life quite simple. So if you look at this trade alert today, when we first issued it, you can see we're agreeing to sell our shares of the SPY at a loss, which at first glance might make no sense. So we can see it was trading at 281.23, and we're agreeing to sell it for 280. So we're basically agreeing to a loss right at this very moment. But that is offset by the $2.30. So as you can see, the spread there is right back to that same old $100 credit. So our goal in the next 48 hours is to protect slightly to the downside, which we are covered to 280, and essentially $2.30 below that. We will realize no losses to that level in the next 48 hours. And if the market goes up, flat, sideways, bouncy, just doesn't end up below that level, we generate the maximum return on this trade in the next 48 hours. So again, if we can pick up $100 3 times a week and do it 156 times a year, the profits really add up. Let's go to the poor man strategy. Poor man strategy has been taking a little beating. This is if you guys follow Jeffrey Gundlach, this is his big prediction. He's the new bond king, 120 billion in management. Very bearish, of course he is. He sells bond portfolios, so he's always going to be scaring everybody as much as he can. Last year, he was extremely accurate with his predictions. And his new prediction is that there is too great a supply of treasuries and that the long-term rates are going to rise over time. And so this hasn't played out yet in 2019, but despite having quite a crash in the underlying asset, we're still sitting on a profit. And that's because we're anticipating essentially a flood of money into the treasury markets, if he's correct. And that's happening right now, which is for a short period of time, potentially elongating the bond market, bull market. But this is something we're expecting will slow down and reverse for a long period of time. And so if you study the Fed fund rate, the change in direction of interest rates can last for decades at a time. So this prediction is being protected with our covered call right now. But as we start to see the TBT rise, that's when we'll start pushing the covered call up a little bit higher. So this portfolio costs a lot less to get started. You can buy 100 shares of the TBT ETF for about $3,300. And if you missed our trade alert from Friday, this would be the recommended one today. So you can see it is a sell to open, 1 contract per 100 shares you've purchased, April 5th, 2019, 33 call option. Wait, I got some questions. Let's see. One sec, guys. I'm just trying to figure out where my question box came. Okay, so Jeff says he's doing good. No audio today. Someone asked, Roadsaw asked which broker to use. I like Robinhood for you guys. If you're not trading above $500,000, it is federally insured, and they pay for all your commission costs. And by they, it's the uber wealthy private equity firms in San Francisco are essentially to build that business. It's now valued at $5 billion, and they are desperate to bring in larger accounts. They've grown a very quick business, giving away free trades, but every last thing that we do in our strategy is completely free on the commission side with Robinhood, and they have a very nice phone app. So you could do these trades 2 minutes on your phone on the go. So that'd be my favorite. I also like Interactive Brokers, and when I was doing fancier trading, Thinkorswim was my favorite platform. But this program is not about trying to be fancy, trying to beat the market. This is about trying to more or less act like a casino and just take in the easy money as consistently as possible. So let's jump into the 2 track records and look at them in a little more detail. And then I was going to demonstrate how to go from A to Z and launch your portfolio, and then we can look at some questions. And this is a good chart to point out. So our strategy, the biggest downside is we potentially miss out on growth. And if you look at the Dow Jones, there's a famous Buffett quote about all the things the Dow Jones has survived, from 2 world wars to crises all over the world to hyperinflation to rates that pushed up towards 30% in the Fed fund rate. So it's really a resilient product. And the catch is that some of these drawdown periods last for between 15 to 20 years. So if we look from 1930 to 1960, there's no growth during that period. So if you're a young chap and you bought and held, you ended up all right, but you really had to weather quite a storm. And then if you look from this period, if you had bought in 1960, you'd have to wait till 1990 just to get back to even. So our program is taking the assumption that you can't afford to have 20 years of negative returns on your portfolio. And so that's why we're very defensive. That's why we're very focused on protecting our capital. And that's why you're going to see quite often, I'm not going to go for that complete $100 credit. I'm going to play it super safe. And we'll go over how we can play it safe in a minute. So let's look over here at our spreadsheet. The current trade was inputted right here. And so our potential profit is in that $100 mark, and that's because the strike was very close to the trading price. If we were bullish, we'd be writing the strike slightly higher than the trading price, and if we were very worried, we'd be writing the strike much lower. And the lower we go, the smaller our potential profit is during that period. Okay, so that is that trade. As we close the position out, we plop it down here. So it's a pretty simple system. And again, that's what we want. We want a very simple system. We want the best security in the world, which is the SPY. And we want something that we can do in a few minutes, 3 times a week. What's nice about this program is you know when we're going to trade, and you already know pretty much what the trade will be. If we go over to the poor man income system, despite a monumental reversal in guidance from the Fed that went against this position, we are still up 3.7%, which is really good. And I think that we will quickly make these losses up. It was up 10% just a few weeks ago before the dovish surprise. But the benefit, when our underlying asset experiences volatility, the premium we collect on the options can double or triple. So Short term, this was potentially a little bit of a setback in the returns on this portfolio, but I think you're going to see that as we continue to write the covered call, this portfolio is in great shape and has a great outlook when you look into the future. Finally, I'll take a quick look and remind everyone on Tuesdays we do the SPY trade, but we break it into the real securities. So Tuesday, I'll really get into detail on that. Essentially, we're looking at what does it actually own. And so this is basically the biggest companies that the SPY or the QQQ ETF holds. Now, it has stripped out Amazon, Google, and Berkshire because those shares are expensive, and it wouldn't fit into our typical client's portfolio. So this portfolio is ideal if you have 150,000 in capital, and it ends up with the allocation that you can see right here. So we have Microsoft as our core position. It's the largest position in the SPY ETF, right next to Apple, dominating the QQQ ETF. So these are arguably the two most important positions in our portfolio. If we go do an analysis of Berkshire Hathaway, you'll quickly see, besides the huge cash pile he's sitting on, about half of his equities is concentrated into Apple, Bank of America, and Wells Fargo. So why does Warren Buffett like banks so much? Probably because if anything bad happens, they'll be the first to get bailed out. So again, you'll see the general theme of our strategy is to find the most secure places to store our capital for years and years to come, and then simply write the covered call. So this program only trades Tuesday at 11 Eastern and uses a similar methodology to pick the strikes. But one advantage here is, for example, this week, we saw a lot of put option volume and short interest flowing into Apple, whereas the rest of the stocks were actually showing very bullish moves in the option market. Everybody was buying call options and no one was buying put options. So in this set of trades, we were a little defensive on the Apple position and then a little more bullish on the rest of the positions. Tomorrow will be our first class on the emerging markets. And so this helps diversify some of your portfolio outside of American corporations. And there are some fast growing stories in China, South Korea, India, Russia, and Brazil. So these represent the 5 biggest GDPs that are considered emerging markets. And so how was this chosen? Why did we pick these ETFs? So if you do the same analysis of what's actually under the cover of emerging markets ETF EEM, which by the way is the second highest traded security in the world in terms of ETFs, after the SPY and ahead of the QQQ. So we know this is where the big money is placing their bet. And if we do look at the underlying assets of the emerging market ETF, it's going to be these ratios in these countries. And once again, if we remove the cushion and get closer to the direct security, the yield nearly doubles and in some cases triples. And so in this portfolio at the current moment, for those of you who have somewhere around 200,000 to invest, you might consider doing the Tuesday class with the 150K, which we call the high yield covered calls, and then the Thursday class with 50,000 in capital. So you're allocating 75% stateside and then 25% overseas. And so this helps take a little political risk and put some of your cash where there is a lot more room to grow. So India's stock market has been absolutely insane and is one of my favorite picks in here, but it only represents 3% of the portfolio. This also gives you some exposure to the precious metals, which we've chosen GDX and SLV. And the covered call income on the gold and silver ETFs is the highest of every security we've covered so far today. So this is only 20% of 25%. So we're looking at, if you were following these two programs, you have around 12.5% of your total portfolio in the precious metals. Then you have around 18% in the emerging markets ETFs, and then the rest of it is concentrated in these critical companies relative to the S&P 500. Now, there is a good argument that this portfolio in the long run could be safer than the SPY ETF. And how would you make that argument? The trend has been that these top companies, one way or another, continue to expand into more and more markets. So whether it means buying out their competitors or just replacing them with better products, trying to do this similar strategy on the smaller tier companies carries a lot more risk. It's really a young man's game to be messing around with any sort of security that's not considered basically in our list top 10 traded securities in the world. So every single ETF or security in this portfolio is really prime real estate in terms of stocks or ETFs. So let's see, this is well, I'll get this one fixed for you guys for next webinar. This one is what you might do if you're a little bit younger, and we use it just to see how the other markets are performing. Europe has been surprisingly strong this year, so I'll get that fixed for the next webinar. But that also helps us keep track of what's going on around the world and how it might.
Hello?
Hey, I was going to pick up the girls. Are they ready?
All right, guys. Now I'm going to pull up Gary's spreadsheet and pretend I'm him with some of his input. Gary, can would you mind unmuting for a second and give me a little input on this little demo we're going to do? See, I think you're still got your mic muted there, Gary. Oh, he wrote a quit. It won't unmute. Maybe it's my fault. Okay, now try it. It was my fault.
There you go.
All right. Okay, let me find the fresh template.
What's your name, by the way?
Jason Cox.
Yeah, Jason. Again, it's Jerry.
I'm so sorry, man. Jerry, well, I said Gary, huh?
Yeah.
Dang it.
No worries.
It's going to be our inside joke, isn't it?
Yeah,
I'll just keep calling you Gary.
Getting a kick out of it.
Okay, give me a second, Jerry. I am locating your new spreadsheet. So you had an old one. I guess you've been reading our emails for quite some time. What we've built is similar to like a car factory, but for building portfolio spreadsheets. And 10 years of doing this, the biggest mistake I've seen most investors do is they don't have a spreadsheet to manage their trades. So that's one of the most important things that that we've implemented to help investors keep track of what they're doing. Okay, so let me find your latest sheet. So tell me which strategy you think you might want to start off with paper trading for this example. You like the SPY?
Yeah, the SPY, yeah.
Okay. And how many lots of 100 are you thinking about starting with? Oh, you already got started. Nice. Okay, can you guys see this screen pretty well? All right, or should I zoom in a little bit? Does that look better?
Yeah, I had actually changed that to 150.
Okay, so yeah, this might be a brand new one I created for you. I'll email you your new link just so that you oops, so that you don't lose it. Okay. So from time to time, I call it the palette. That's the list of ETFs we have at our disposal with our management system. So you'll see the different levels of sophistication have a different palette. And in this palette, we're really just using the green right now because we think the market's going to go flat or choppy at current time. Now, if we did get bullish, we might switch over to these blue ETFs and do the weekly covered call. But for the foreseeable future, the SPY is the best bet. So I'm going to go over here and put in your 150K. Now, are you thinking about doing the high yield, or you want to do the SPY?
I was kind of contemplating that because I'm
Let's
pretty.
do both for demonstration purposes, okay?
That would be great. Yeah.
All right. Who's your broker? Tell you how much your commission cost is.
Tasty Works.
Oh shoot, I don't know who that is. All right, probably $5.
No, well, actually, they're dollar contract.
Oh, all right. Not bad.
They don't charge you on the on any sell, so it's just when you buy it and it's free to sell it.
Okay. So, all right. Yeah. No matter who you're using, we're not doing, the only time you really got to get scared about commission costs is if you start trading out of the money option contracts. And we're not doing anything of that nature. So the commission cost is very low to start with. All right, so we're going to buy, no hold time yet. Build. Okay, so now you can see it automatically picked up that we have 400 shares. And it says, all right, you have a target of 90%. And you've reached 74%. So let's see if I wanted to push it a little harder and go to 500. So now I'm only 2% above, which is good. And now I can make an extra $300 a week. So I would be okay personally being a little light on the cash right now at least, and being able to generate the extra income. So it is important that we do have a little cash position, because from time to time we're going to put on a hedge, and that hedge is going to involve a in-the-money call option on the VIX as far out as we can purchase, and then it's going to involve a out-of-the-money put option on the QQQ, which can go out typically 2 years. So once we do get more signs that the market may have some rough times ahead, that's when I would put on the hedge. In the short term, we can protect our portfolio and generate profits just from the covered call. And so if anybody's ever bought an option, I'm sure you know how hard it is to actually end up with a profit on it. So you'll see that I'm very reluctant to really bet against the market with long option contracts. Okay, so we got the first thing in. Let's look at today's trade alert. So we'll see how we would put in today's trade. And I'll pull up, let's see the live quote. So we're always going to be doing the next drop down. It's usually 48 hours away. The weekends are a little bit longer because there's the 2-day weekend versus the single day in between. And this is the option chain. This lets us see where all the volume's flowing. And it's changed this morning. It's the volume has been heavy right here in the center, which is why we chose that 280 strike. So if I wanted to write it right now, all right, pop quiz, Jerry. How many contracts can I write?
5.
You got it. Okay, now if you do use the Robinhood app, they're not going to let you do a limit order. If you do a limit order, typically to get filled, I'll usually go on, when I'm trying to sell the option, I'll go 1 penny under the mid price. And when I'm trying to buy it back, I'll go 1 penny above the mid price. But the SPY is so liquid that you guys are perfectly fine doing a limit order. You'll probably get better pricing that way than trying to play with the penny up or above the mid price. Now at the TBT trade, so there you go, there's your trade. Does anybody have a question about how to write a covered call? Okay, so I think that's pretty simple. You buy the stock and then you sell to open. All right, let's quiz you again, Jay. What do I have to do to close the position? Which of those 4 options would I choose?
You go buy to close.
Yep. And then what would be the next step for the next trade? Go to April 1st, sell to open, and then we'll just adjust whatever the strike makes the most sense for that day. Okay, so that's how easy this program is. Let's demo the high yield now. So that one's a little more work. Let's do that one next.
Okay.
So again, the advantages of the SPY is that we can adjust our strike 3 times a week. We can follow the momentum of the market. We're a small portfolio, so we can actually go with the flow rather than try to get ahead of the flow. So Mark said for more leverage, you can use the SSO ETF as a substitute for the SPY. Yeah, I don't like leverage. I highly recommend not using leverage, except for obviously our TBT's a double levered ETF. So I guess I'm a hypocrite. No, thanks, Mark. I appreciate that, and I'll definitely look into that. So the biggest benefit of the SPY is we can track the momentum of the SPY 3 times a week and quickly react to the direction of the market. Big hedge funds, big mutual funds, they can't do that. They really have to predict the move before it happens and make their move early. And that's the only way they can move such huge amounts of capital around. And that's why, as a small-time investor, we can get a much better return, be much more careful with our capital, and do this brain-dead easy trade. Now, the downside is the yield on the SPY is about half of this portfolio. And when you look at it, this is a very correlated portfolio to the SPY ETF. And one of the most fascinating things that's been happening for the last few years is stock buybacks. The stock buyback index is outperforming the S&P 500. And so guess who the biggest stock buyback companies are? That's these folks. Apple has some $250 billion in cash, and they're watching the Fed basically announce that they're getting ready to start QE5. So do they want to hold on to cash as the monetary supplies, who knows, doubled again in the next 10 to 20 years? Nope, they're buying their stock. They think their stock will go up, and if they ever need the cash later, they can just sell their stocks. So that's where most corporations are piling their excessive reserves. And another good reason that these particular 8 companies, which dominate the holding in the SPY and QQQ ETF, are so attractive. So let's go ahead and do this one. Okay, so it's got the 150K deposited. Okay, I'm going to teach you guys some Excel secrets here. If you hit Control-C, that copies. If you hit Control-Shift-V, it will paste it in nicely. If you don't do the Control-Shift, it messes up your color scheme, and that's not fun. So if I hit Control-Shift-V, we can plop it right in there. If you hit that little arrow, you can drag it down. All right, so let's look. So I'm going to go 300, 100. This is okay. Let me put the prices in first. So this is just 15-minute delayed prices from Yahoo. Obviously, you'd put in your real price and you wouldn't just copy paste it in. Okay, so now here's where we're not going to follow the trade alert exactly. Now we need to use a little common sense. This calculator is telling you what it takes to hit your target goals. And so right now, we have 23% targeting the steady income setting, which is this green line. And right now, and probably for the foreseeable future, Microsoft will remain our core position in this portfolio. It's arguably the most important corporation in America. And funny enough, the owner of that is one of the few people richer than Warren Buffett. Go figure. Okay, so we go over here, high yield set to 40%. That's where we've got the big Apple position. And then it drops significantly. And so we're really looking at who has a serious monopoly that's not going to disappear. Microsoft has a clear monopoly with its Windows platform. That's why it's the biggest position in the SPY. Investors can count on this company continuing to sell its products for decades to come. Okay, Warren Buffett's biggest position is Apple. Of the few people who could outperform the stock market over the decades, that's one of the very few. So a lot of our portfolio is following where he's betting his portfolio. So we've got the Apple and the two banks. All right, so we don't want 296 shares of Microsoft, we want 300. We don't want 104 shares of Apple, we want 100, 100, 100, 100, 200, go 800. Let's see what it looks like if I go 500 on that one. Okay, so I still have 9.8% of my portfolio in cash, so no problem on the cash side. I'll be able to hedge my portfolio when the time comes. And I was able to get an extra covered call on Wells Fargo. So I really like the way this started out, and I think that's a great starting point. Now this part, you don't have to, if you don't want to fill out this part, you don't really have to. Let's see what would happen if we want to go sell these today and see how it flows up above. So if I put a negative, just do it on the first few. Oh, now we have 0 shares. So it's a pretty simple piece of software, but it will keep you organized. It'll keep your allocation size calculated perfectly. And it really sets the stage for you to be able to organize and keep track of writing covered calls on 8 securities instead of 1. So now we have to keep track of 8 things once a week instead of 1 security 3 times a week. So the next step in this portfolio would be to wait until the next Tuesday. So unlike the basic program where I tell you the trade for the TBT all week, even though we know we're just going to roll over the position every Friday, this portfolio is too complex. So your best bet is really to enter the positions and write the covered call on a Tuesday. You probably wouldn't want to just jump into it on a Wednesday and then have to wait all the way till Tuesday to start protecting your portfolio here.
Why do you pick Tuesday instead of Friday on the expiration?
So we're doing Tuesday to write it, and we're not having it expire this Friday. We're going out the next week. So I think that's 11 trading days. And so most of the value in the option contract is wiped away in the first half of the option contract. After that, the value of that option is just exponentially dropping. So we've made most of the option premium by the next Tuesday, and we'll actually generate a better return in the long run by rolling it over towards the middle of the length of the option contract. Does that make sense?
Yeah.
Okay. Another thing is that if I'm doing classes Monday, Wednesday, Friday, I can't do this class on those dates either. So some of it was really just logistics on my end. But I would say that the date and the Tuesday does not affect our results in a negative manner. It really wouldn't matter which day we started. We would do something very similar.
Okay.
Let's see, we got some more questions in here. Mark says oh, you want me to unmute you, Mark? I think you're just talking to your daughter or something. So. Okay, Mark asks, with buybacks, why are the top executives selling their shares according to Open Insider? Yeah, so that's a great point. Something everybody needs to realize about the stock market. Let me pull up this chart. The value of the stock market, some $21 trillion, but the reality is there's only around $2 trillion in the monetary supply. I think it's up to 4 now with what the Fed's been up to. But the point is that most of the shares that are owned by these different companies were never sold. They were just given to the owners for free. And so at any point in time, if there is a panic, the value of these can have huge swings for long periods of time because there's just not enough dollars in the world to buy all these shares. So it's at any given time, it's typically levered by about 90%. Now, we haven't seen a crash like this one where the market went from 5,000 down to 1,000 in a long time, especially in that short period of time. And we look at the 2000 crash and the 08 crash and the length of them, and then we go back in history and look at some of these other bear markets. You can see that was short. That was really quick. So yeah, is it a good sign that the insiders are selling their shares? Probably not for people who are counting on this thing going up forever. Most likely not a good sign. Does it matter for our portfolio and our strategy? No, it doesn't. Not at all. Do I watch that sort of data? Absolutely, definitely. And of course, if insiders start really unloading, that's a very bad sign. Now, can that be offset by other factors? Sure. You know, the biggest thing we like to watch is the interest rate of the central banks, because you got to think about it. If we can borrow money for free or close to free and invest it, where are you going to put it? Most likely in stocks. Now, the Fed jacks up the rates, costs 5–10% to borrow money. Are you going to get a return greater than 5 to 10% a year in the stock market at this valuation? Probably not. Everybody's going to freak out. So that's the most important indicator is the moves in the interest rates. Another big factor is going to be if tariffs rise. If you go look at this crash, what happened right before it? Tariffs. So if we get a global trade war and get everybody to panic, you know, then that's when we're going to start to put on our VIX and our out of the money QQQs. For now, rates are low, bond yields are low, stocks are attractive. So we're relatively bullish right at this moment. But we're not trying to get growth. We're trying to hold the asset, sell the covered call.
Jason, implementing the SPY, what kind of income can we expect?
We're trying to pull $100 3 times a week for every 100 shares we own. And that totals around $15,000 a year just from the covered call. Now, we may miss out on some of the upside move in the SPY, but that's not our goal. We're not trying to go for growth. Our clientele is too old for that. We need to play it safe. We need to plan for an environment that's more like this or like this with our mindset so that we don't risk losing a huge amount of capital at the worst point in your life. This is where it's time to play it safe, have something very valuable you can pass on to your kids later down the road, and have a consistent income stream.
Okay, thanks.
Yep. Let's see. Let me clear out. We're getting a bunch of questions piling in. Oh, okay. These are mostly old. Let's see. Throw some more questions at me, guys. How about some negative comments? What's your fear of this product, your concerns, maybe of our company? Anything I can address along those lines?
Yeah, sure. I did. What made you come up with this strategy, Jason, and your experience in doing this type of method?
Sure, fair enough. You got a 33-year-old, scolding you guys for taking too much risk in retirement. So that's a fair question. So my experience was not being the stock picker at all. And that's not to say that I wasn't avidly reading every piece of information I could get for the last about 12 years now. But I was not the guy pulling the trigger on
Your
the trade
mother's
alerts
here.
for most of my career. And so what was my experience? I was going out and finding the
You
pro
guys ready?
traders with all, oh, sorry. I was going out finding the top dogs with the best pedigree, the most credentials, and I was going and selling their products to the public. And let's talk about what happened when we did this. We've got a bunch of hobby traders who don't know how to work a spreadsheet, that don't know when the trade alerts are going to come, receiving information typically from very professional level traders who are super advanced. And so my experience time after time was that the hot shots, they are not interested in trying to match the S&P 500. They think to provide value, they need to beat the benchmark. And so a lot of them can do it for years at a time, but not over a long period of time. And furthermore, the ability for the average Joe retail investor to be able to consume the information flowing to them and act quickly enough was a huge disconnect. Sure, a lot of people could do it, but a lot of people could not do it. And so this product is trying to remove the goal of trying to beat the market. We're going to show you how to simplify your investment strategy. Let's see where the most money is being stored in the world. That's where you should put your bet going into retirement. And so this product was designed to be easy to follow, to try to track the benchmark with a little less volatility by doing the covered call. And so, sure, yeah, I've got a big road ahead to prove to our audience that I'm the guy to follow and to listen to. But that's why we do the reverse order in selling our product as everyone else. Everyone else has got a big sales letter, takes your money up front, and then just hopes you forgot you ordered. Quite frankly, they have 50 to 75% of their folks refund. They're spending a fortune on advertising. They're blowing out their credit card. It's just a huge joke. Sometimes, like Agora will go out and hire college kids to issue the trade alerts, and they're just chasing the next greatest thing. And it always ends in disaster. So most of this program revolves around trying to get you to not take stupid risks, to do something very simple that you can do in a few minutes, 3 times a week. And we want you to try the full product, do the trade, see the result. It's a very repetitive process, and we're going to be doing this for a long time to come. So our business model is give it to you for free, let you try it out, and if it makes sense, join us every week.
And what, all sounds great. What made you want to pick, the older crowd to care about, I guess, and yeah. What made you focus on that in itself, which I think is cool?
Well, let me ask you this: when do you have any kids?
Sure, yeah, two, yeah.
Okay, how happy was your child to take a lesson growing up? Did he like to figure it out on his own, or was he ready at every moment to listen?
Oh yeah, of course. Yeah, they don't
No,
like.
they don't want to listen. Young people, they want to chase. They don't have much money, first of all, so they're not going to pay me much for my time. Number two, they want to chase ridiculous returns, and they're just going to lose their money for a long time until they wise up.
I see.
So the answer is, we have far more reasonable people to deal with who will pay for our time and appreciate this bread and butter strategy targeting the 50 to 70-year-old crowd.
I see. Yeah.
You guys have saved up, you've learned your lesson, and so it's not that hard for me to convince you to take a nice steady strategy versus a high risk growth strategy.
I see.
Okay, I got a question from David Jones. What's the expected return on the TBT trade? It's the same as the SPY. The yield's a little higher. Let's talk about the TBT. We could spend hours just talking about the bond markets around the world. So it's a horrifying chart. If I didn't have good context to the TBT, you might think this is quite frankly the worst ETF in the world. It crashed from 290 in 2008 to 3253 in 2019. And so this underlying asset will go up in value as yields rise on the long end of the treasury curve. And so the big prediction is that we're going to go back towards a 200-year average where cash costs right around 5%. And most likely, the way markets work is they go way above or way below where they should before it gets rational and goes back to where a more normal average is. If we get anywhere near 5% on the 20-year, this ETF is going to trade at 140. That's a huge run. So that's why we like this pick. Could we potentially go to 0% interest rates in America? Negative interest rates like in Europe or Japan? It's definitely possible. And so if that happens, this will go lower. So we're currently following the trend. We're a little guy, we can follow the trend. Right now the trend is that all the central banks are lowering rates. How long can they do that before you get inflation? And so really one of our best things to study is inflation. Let's pull up a chart of inflation so we can see just how wild inflation can come and go. So I'm going to close this and pop it back up and we'll have our settings. Okay. So there's different measurements to inflation. But this is a very interesting thing you could study. You could spend hours on it. I know I have hours and hours and hours just studying the patterns of inflation relative to two things. We want to know what the effective Fed fund rate was relative to inflation and how that reacted relative to the Dow. And so there's no single indicator that will tell us up or down or anything of that nature, but this has been confusing the central banks for quite some time. They continue to increase the monetary supply, and you've got I don't know, has anybody listened to Peter Schiff's podcast out there?
Yeah, I have.
Yeah, Peter Schiff, I love to listen to the guy. His call will always lead to buying gold, so you got to take that with a grain of salt. But he's been yelling about hyperinflation coming for about 5 years at least, probably for his whole career because he sells gold for a living. But there's no inflation. We had a huge drop in inflation this year. So that means, there's a lot of arguments, but essentially, if we can create more money and flow it into the economy and we're not seeing inflation, then basically that may mean that our economy has become more productive. As we look at things like Amazon, we go back to this story where corporations are gobbling up markets and delivering products at insanely low prices. So how much money did you spend at Blockbuster every weekend renting movies for your kids growing up? A lot more than you pay for Netflix. So in general, technology has allowed for the cost of goods to be created for much lower prices. And although perhaps us retail consumers haven't enjoyed those drops in prices, the corporations have. That's why they're buying back their stocks at record pace. They're making more money than they know what to do with. So this is one of the key things we're watching. And eventually, if you print too much money, you get inflation. And we have the entire world puzzled why they keep printing money and there's no inflation. So this is a trend that if you do study, it comes all at once. And so we can see periods of time where there was staggering inflation, and that forced the Fed to, guess what? Raise rates all the way up to 17.5%, 1981.
How long have you been in the TBT trade, trading this against the TBT like this?
Oh, sure. So let's pull up our chart record. We'll pull up a chart first. So we launched all of these model portfolios at the same time as we got the product ready. At some point in my career, I gave up trying to coach these so-called pro traders into, how can we create a product that actually works, that people can follow and that they can do for a long time. And so we launched in a unforgiving period of time, but we've done well. So we launched right here, all of these portfolios. So normally you think you're buying the dip and have a great instant return, but not us. We had to deal with this Christmas massacre. And so luckily we were the little guy following the momentum. We were writing covered calls a little bit below the trading price. And this drop didn't hurt us nearly as much as everyone else. And then did we get this insane rebound? No, we didn't capture all that, but we made a good profit by doing the covered call. So you can see by doing the covered call, you can take the sting out of the downside and potentially make money. We were not predicting this precipitous of a crash, but we were able to reduce most of that volatility during that period. I don't have anything that shows the day-by-day drawdown, but that's something we could add in the future, so we could actually see what our maximum drawdown was. But the general idea is we can use a covered call to almost completely erase most of the pain the market might give us on the downside. So the TBT, let's check out what that's done since the same time period. So TBT got started right here. So we squeaked out we were up a lot more until this drop right here. This one was outperforming the SPY, even though it had done this choppy move. Now this is a little misleading. If I go like that, you can see this is a pretty flat product relatively for the last few years. And so our expectation is the central banks will do what they love to do. They will print until they can't. During that period of time, most likely, TBT is going to have a little pain, and the SPY ETF's likely to do well. But once the inflation starts coming in, and now they're saying they actually want to go over their 2% target, so they're now saying they want it to run hot before they'll actually get hawkish. And so, yeah, our expectation is they'll do that until they can't, and that's when this is going to potentially have a rapid rise. So once we do see the TBT running in our favor, we'll likely take the covered call income and start buying leap options on the TBT. And that's how this portfolio can really outperform everything else that we've even discussed. Of course, it's a much more bearish outlook that may take quite a while to develop. Things happen so slowly, and then they happen all at once. And that is what I'm expecting on this one. So we're playing the covered call relatively safe. We didn't predict that the last Fed meeting would be so dovish. So we hadn't wrote the strike that far below the trading price. So that's why we lost some of our profits. But the benefit, the volatility on the MOVE index, which tracks treasuries, has jumped. And that means our covered calls are going to pay us much more money now.
And then through all of that, the portfolio for this is still up though, huh?
Yeah, it's up, let's see. So typically after a period of drawdown will come a period of good results. It's at 3.9%. It was close to 10% just a few weeks ago. So certainly it gave up some of its profits. But that's okay. You know, that is okay. Once again, to do the covered call strategy, you really need to understand the underlying asset and the risks you're holding. And luckily, tracking the bond market is absolutely critical to predicting the SPY ETF. So that it all ties together, and that's why we like the TBT. We have a good understanding why that 20-year yield can't go much lower. If it goes much lower, number one, foreign investment's not going to be attracted to it, even though it's flooding into it right now. And two, the deficit is exploding. We're not trying to reduce any deficits right now. And perhaps that would shrink the GDP. So maybe it's not a good idea to shrink the deficit right now. But that supply is growing rapidly. And so if you have a decreasing demand and an increasing supply, the price has to rise. So we do think the yield will rise over time. And once the market's agreeing with us, you'll see we'll be a lot less defensive, and we'll start getting a lot more bullish on that theme. Oh, Mark, you want me to unmute you? Sorry, I think you're, here you go, buddy.
Okay, no problem.
I don't like to backtest strategies. Sure, I used to have a whole team of programmers for our larger company, Market Authority. That's all they did. They go sit there and backtest, but so misleading. It's the worst thing you could do is tell an investor, here's a performance of the past, and try to extrapolate that into the future. What I'd prefer to do is tell you what's going on right now and what our plan is moving into the future and what we could potentially see as an outcome. So yeah, not interested in trying to advertise some sort of back test. That's funny, Mike. Yeah. Back testing's fun. You could play with it all day, but really what's more important is trying to figure out which market environment we're going to be in based on the fundamentals. And so, you know, our bigger concern is a 16-year bear market. So, you know, good luck finding back-tested option strategies from 1966 through 1982. You know, you're not going to be able to do that.
You know, in the case that you know, if something were to occur like that again, God forbid, then I think the plunge protection team at this point would probably be stepping in all the time. But if we did do that, you know, over a lengthy period of time, and we're talking about guys like us who in 16 years, some of us may be ready to croak.
Exactly. Yeah, you're at the final stretch. You got to play it safe. So what are
Yes.
we do if we think that's really happening?
Yeah, I just wanted to know because obviously generating a monthly income is our most key thing.
Right. So let's just picture this happening. Let's say the top 500 companies in America have negative growth. Oh man, that will cause a panic. The last standing, what's the word? Last standing domino is America. That's why, despite record deficits, despite China slowing down, despite everything negative, people are flooding into the bond market and pushing yields to insanely low. I think just yesterday, huge foreign demand. And so if they were to hedge against their currency, the yield on that is negative. So there's no sense in doing that if they ever were assuming they would convert it into their own currency. So what's happening? The rest of the world is freaking out. They're very scared there's going to be a slowdown in China, and that's where most of their business comes from. So it's a real risk. It's a real concern. So what's happening right now? Right now, the money is flooding into America. They look at it as the last safe place. The U.S. Treasury is the safe haven to store your money. And really what they're doing is they're betting that, they're not really that interested in that 2% yield. Sure, the central banks maybe, but what do they really want to do? They want to predict, let me pull up, I got a different sheet I want to show you guys. The speculators we got a lot of speculation in the bond market, and they're thinking that rates are going lower. So they're buying the bond so they can sell it in a few months. But what happens when everybody tries to sell it at once they realize we're not going any lower? Or the Fed comes out and says, hey, everything's great, trade war is resolved, we're back to raising rates. So that's really, let me pull up this chart for you guys. Oh, shoot. So, okay, let's go back to this. So the question is, how do we deal with a 5 to 15 year bear market? So the big sign that we'll see from a mile away is the central banks start to raise the rates. So right now we probably have a last hurrah. We're going to have likely the bull market and the bonds going farther than anyone predicted until everyone realizes it can't go any lower and they all want to sell at once. And that's when I think our TBT is going to start to run up and our SPY could potentially enter a period of time where it's going down. So we'll have two options. One is we hold the SPY, we write the in the money covered call, we buy the VIX, and we get the QQQ. So that's one option that we very well may take. The second option is we may put a larger position into that TBT. So it'll be very clear when central banks are reversing course. And they're not going to reverse course until they're done being scared about China's slowdown. So China's printing money, trying to pump back their economy. Everybody tried to raise rates last year, failed miserably. We had 98% of asset classes lose money as the big central banks, China and America, were trying to pull money out of the system and raise rates. So they found themselves in a trap. They will probably keep lowering rates, printing money until inflation hits. Then they're going to have to raise rates. That's when it will be crystal clear that the stock market's in trouble for a considerable time. So that's really kind of the roadmap that we have right now. In the short term, though, what happens when the central banks are buying? Everything goes up. So that's really our outlook in the short term and how we're going to potentially see some trouble in the long run. But again, if we do see it coming, it's really not a problem. If we write the strike below, we make the same income whether it goes up or down.
I think what's important, though, I guess it's really probably being able to understand and pick what in the money calls you're going to sell at that point, because I mean you're trying to, I guess, judge how fast the market's falling, aren't you?
Right, yeah, exactly. And we got to realize even if it does lose some of its value for a period of time, we're still going to be generating income. We're going to reduce the losses dramatically and potentially show a great profit. So let's talk about how we can hedge and deal with disasters. That's a great idea. Oh wait, Jeff has a quick question. No, Jeff, he says, do you generally write 1 to 2 strikes below if you feel the market's going down? No, I write 10 strikes down. And just recently we did that, and it paid off beautifully. I was worried that, God forbid the central bank wants to act responsibly and start cleaning up the mess. So just recently we had 10 strikes below. And the reaction of the market was crazy. It went straight up and then it crashed the next day. And we hit almost a maximum return on that trade. So let's look at the 3 ways we protect our portfolio and the pros and cons of it. Because, of course, there's no free lunch and there's always a catch. Okay, so let's say something bad happens that we think might panic people. Really, that's the big fear. It doesn't matter what the economic data is, whether we're growing or not. Really, our biggest fear is a lot of people panic all at once. And so that is by far the biggest concern with this. So if I were to be very bearish and say that we're going to have a historically highly unlikely event where we're going to lose $10 in the SPY in the next 2 days, it just doesn't happen very often. Let's see what the worst thing that could happen to us if we did that trade today. So if I wrote this covered call right now, I'm agreeing to take a $10 loss because it's trading at 280.11. I'm going to sell it for 270. Okay, so I'm taking a $10.15 loss if I get that defensive up front. So my only hope is that the value of this option will decrease over the next 2 days. So I get the credit back of 10.08. So if I go this far deep, if the market goes up and we get assigned, we're going to lose $3. Let's see, no, $7. So if I get super defensive and the market goes up, I might lose $7 on that trade. But if the SPY travels any distance between 280 and 270, we're making money. The only way we really could have a unrealized loss is if this were to drop below 270 in a 48-hour period. So how do we protect against extreme drops? So we always have this mindset that, hey, we don't really care what the underlying asset's doing because we're going to keep writing income, and we think over the long period of time, this is the best asset to own. Think about it. If the S&P 500 drops, they're going to start doing layoffs, unemployment's going up, people can't pay their rent, a lot of problems are happening. Real estate's going down, bond yields are going up. There's nowhere to hide. Maybe gold, who knows, but the SPY ETF is really the core of the world economy. So if it goes down, everything's going down. So let's talk about nightmare situations in the S&P 500. So first of all, we can track the downside movement every 48 hours very easily with the covered call. And so you can't do that with Microsoft or any other stock or ETF. You can only do it at a weekly basis. So that's one huge advantage with the SPY. The next trade we're going to look at is this. Is everybody familiar with the VIX?
Yes, I kind of like the VXXB.
Yeah. Oh, yeah. We were talking about that last. Okay. So if we're going to go long the VIX, most likely you're going to see a trade where it's going to be an in-the-money call option. This sucker is very hard to get a payday on, and the expiration's not very far. So we have a lot of factors against us. Let's talk about why there's a lot of factors against us. So first of all, it's important to know the entire financial system is leveraged to the upside. The world economy does not work if the S&P 500 is losing value. Everything is tied to it. So all the big money around the world, they have no choice. They're not going to hold cash. They're going to buy the S&P 500 with a huge chunk of their cash. And so over the course of time, people have started to figure out they can actually make a lot more money by shorting the VIX. There's a huge amount of capital that does nothing but wait for pops in the VIX, and then they use, I would say, intermediate level option strategies to short the market back down. And this process has created a lot of stability in the S&P 500. So trying to bet that you're going to get a big spike in the VIX is a tough bet. And they only let you bet 6 months out. So we're going to be very cautious to put on this trade. But if you look at 2008, if we do get a crisis, we're probably looking at a VIX that hits between the 45 to 60 range. And so we've had a few scares, 2011, 2015, 2018, but you can see nowhere near the 2008 level. So this is why we want to buy the in-the-money call option. It has to go up a lot less to start seeing a return. So we can take basically a medium-sized crash pretty well with the VIX. We're not going to be getting some huge payday. So that's how we'll trade the VIX when there's real reason to be fearful. Because we got to go into that realizing we're probably going to lose money on it. Okay, now let's look at the next trade. This is how we can really get some serious protection from a financial panic. So the QQQ is basically just a more reactive version of the SPY. It's the NASDAQ index, and this will potentially move down faster than the SPY. So it can act as a great hedge for a portfolio. And it also has the benefit of giving you a lot more time for your hedge to pay off. So if we go to this one, and this funny enough is how I got lured into the stock market. I'll show you guys. So we can say, all right, we need protection through 2021 because we want to do this for a long time. We want to generate income and we don't want to have to worry about it. We can buy a very far out of the money option. And the lower you go, the cheaper it gets. The fellow I met had bought between 1 cent and 25 cent out of the money put options on the QQQ in 2008, and this fellow had walked away in his Ameritrade account of all platforms with 10,000% gains left and right. And so this is a very, very rare event when you get the whole world's panic and don't have the central banks propping the market and stopping such a crazy crisis. And so we can see in the last 10 years, the Fed has prevented market crashes by pumping more and more money into the economy. So we've had QE1, QE2, QE3, QE4, now we're getting ready to do QE5. So once again, if we put on the out of the money QQQ option, we're not trying to get rich with it. This is our insurance policy. It lets us have the confidence to write the covered call. Now, if we're taking in $1, I would expect a potential return of around 1,000%. And if we go even farther out, you know, you might be getting towards the 3,000% if you get a 50% crash. So
How
That
many of
just
those?
doesn't happen very often. So we're going to be very careful about wasting any of our capital to buy this insurance, and mostly use the covered call to weather the storms. And
How
so
many
I
of those?
do believe there'll be some pretty good signs of when we want to build this hedge and maintain it. And so this will be designed in such a way that we want to keep 9% of our portfolio exposed to the VIX. And every week, as it loses its value, we have to take some of our credits and replace it to maintain the right hedge. And the same with the QQQ. The longer the market goes up or flat, this is going to deteriorate in value. Now it's a 2-year contract, so it's going to go a lot slower. But yeah, we could waste a ton of money worrying about the end of the world. And I'm going to try my best to help you avoid doing that until we really need to. And that'll be based on central bank interest rates, China trade war, is China going to start to clean up their economy, or are they going to just keep printing money and building as fast as they can? So a lot of it really hinges on that. And then when does the world start to see inflation? So those will be some of the big warning signs that probably will be way early. The way this always happens is the trend goes longer than anyone thinks possible and then suddenly changes. So when we do put on the hedge is going to lose money every day until maybe it really saves our ass. But in the meanwhile, the covered call allows us to provide protection with a no risk scenario up to a certain level. So I can get right now with the low volatility, we can get around $10 of protection for free and still have the opportunity to make our normal income. The higher the volatility gets, the farther out we can go for the same deal. So as the volatility spikes, these option contracts become much more expensive relative to the distance from the trading price. So as the market is in a decline, we'll be able to push this even further and still have an almost no lose situation. So if we go look at the delta right here, it's 97. You know, trying to use probabilities and odds and such, I hate to do, but in general, that is a ballpark probability of this happening. So this trade would have the potential for a 97% win rate over time based on the way the options are trading right now. Now, we're not going to get rich with that trade, and we're going to miss out on all the upside, but we're not going to lose if it goes up. We're not going to lose if it goes flat. We're not going to lose unless it goes below 270. And even if it does, that's okay, because we're going to keep writing covered call every 48 hours. Okay, Mark says, is cryptocurrency going to the moon? Just kidding, he didn't write that. But he basically said that. Don't you think they want to crash the currency, introduce a new monetary control system, i.e. crypto, SDRs? Well, I think that China and Russia would love to lose the dependency on America and are making all the moves to do so. But right now, the dollar's strong. That's another key thing we're watching is the dollar index. So if you look at this time period, dollar looks really strong. And that's because everybody is ditching their own currencies and their own government bonds, and they're afraid. They're flying into America. So we're almost getting a repeat of last year. Started off strong for America. The rest of the world was doing terrible, and then it caught up with America. So if we look at the all-time picture of the dollar, a little different story. So there's plenty of people who have been predicting the demise of the dollar for decades. Will it happen? Well, you know, that's something we're watching very carefully. But if we see a weak dollar, that would lead me to recommend a bigger chunk of cash in the emerging markets. Strong dollar, less money in the emerging markets. As far as cryptocurrencies, we do have a lot of people. Our first product we put to the market basically taught folks how to build a index of the cryptocurrency world. So the big bet there is that the central banks and the governments are going to take advantage of their ability to print money and decrease the value of their currencies, which is what pushes cryptocurrencies higher. So definitely in the long run, I do like Bitcoin and the big coins. And I think that as time progresses, that we'll see debt levels just continue to pile up, and cryptocurrencies will continue to play its role as they hedge against inflation and losing your buying power with your own local currency. Now, do I think it will overtake the dollar? No, but it doesn't need to.
Is there a way
Any other
to,
questions out there, boys?
yeah, is there a way to, and I guess it's probably my own fear factor at this point, but is there a way, or even if it's wise, is there a way to diversify the portfolio with the SPY with the high yield?
Yeah, so totally. If you have enough capital, it makes a lot of sense to do all 5 classes. But yeah, so tell me, just capital you're considering, and I'll show you the most diversified setup I would probably do myself. Not that I'm recommending it for you at this moment.
Just
We'll
100.
say for my father, he's 69. What would I do for him?
Yeah, let's just say the 150 level, just to keep
All right,
it
let's see how we could put 150 to work and spread it out a little bit. Okay.
great.
Okay, so pull up your sheet. All right, so I have dropped this down to 200. So we got about a third of your capital right here. Then we're going to come over to high yield. What about emerging markets? Do you want to have some cash over there or no?
Not really.
Okay. Stick to what you know. Good plan. So now we got to figure out how are we going to build the $150,000 portfolio with only, I think let's see, we had 90 left, right? So I'll go change this to 90. And I'll put this at 60. Okay, so we've got 7% left in cash to hedge, and your broker will probably loan you the extra 3% you need against your SPY share. So, if we're going to use 3% leverage, it's not a big deal. So I'd be happy with that for this. Of course, we'd have to go plop that down to 2 contracts. Okay, so now let's go see how can we modify the high yield to only need 90K. So we're going to we got to turn off one of these colors. We can either turn off the Microsoft, the high yield blue, or the banks, or we could potentially turn. So if we were really concerned, this might be the best too. What if I turn off the green and the yellow for you? Does that sound like the stocks you'd want to be doing, the Apple, Facebook, Intel, Cisco, or do you want to be doing the Microsoft?
Yeah, I'd probably want to do Microsoft and eliminate Facebook, I guess. And I'm not sure. And I was pretty unclear about really wanting the banks.
Okay. Do you want bank exposure or no?
No.
Okay. All right, so you're allocating this portfolio completely to America's most important corporation according to the S&P 500. And so let's go ahead and check out our order. I'll delete all this. Oops. Nailed it. There you go. How do you like that? Now, fair warning, Microsoft is one of the least volatile stocks in the world. So its yield it's better than the SPY, but it's far less than the rest of the stocks, and that's because it obviously has a monopoly it's not going to lose. So that's why the yield is a little bit lower, but it's still, I think it's about double. Let's just see right now. Let's just do a side-by-side comparison of the yield we can pull on Microsoft relative to the SPY. Just give me 1 minute. I'm just trying to, I got so many windows open here. So it'll take a little math, but when I input it into the spreadsheet, it'll show us. All right, so let's pick a date. I'll go for next Friday. So that's going to give us 7 days, trading days plus half of today of option premium to collect. And we'll just go with the strike right above the trading price, 1788. Okay, sell to open. Okay, so you can see that yields right around 1%, and there's a tiny bit of upside in the underlying, not much. So just under that. That's probably about 0.8. I'll type it in so we get the exact figure. And then we go to the same date on the SPY. We'll do similar trade. So I'll do that 278. Oh no, wait. Yeah, 278. Oh, wrong one, sorry. $280. So at this very moment in time, those are pretty close to the same yield. So just the quick math in my head is I see a 1 here and a 1 here, plus the 18, so that's right around 0.8. And this is at 280 and 250. So we're getting a pretty similar return. Let's type it into your platform and just see. I apologize if you guys hear any background sounds. So, and before I do that, let's just take a look at the chart just so you get a feel for how the market rewards risk takers based on the volatility of the underlying. So the volatility in the Microsoft stock is remarkably low. And even during the crash where most stocks lost between 20 to 50% during this period, it went from 115 only down to 100. So by all measurements, Microsoft appears to be one of the safest places to invest your money in the world. It's the largest position in the highest traded ETF. So it has this constant flow of capital flooding into its stock. They buy their own stock back. They have a monopoly. There's a lot of reasons why this is what it is. Now let's look at the SPY. Okay, SPY had more volatility than Microsoft. So I think the SPY is actually going to ink out a slightly higher yield at this very moment once we actually calculate it. But now look at NVIDIA. This thing lost half of its value recently. What do you bet it has a higher yield right now? So if we compare NVIDIA to Microsoft, might get a better idea of so wow, we take a stock like NVIDIA that just experienced huge amounts of volatility, and you can see how people get lured into taking on high amounts of risk. Would you rather take a safe 0.8% yield on Microsoft or the SPY? So you got to realize that in that portfolio, Microsoft is basically replacing the SPY as our steady income. So we shouldn't expect to see a huge jump in the income for Microsoft relative to SPY, because by design, that it's labeled steady income. So what would you rather do? Take NVIDIA and pull a yield over 2%, or would you rather take the safe bet with Microsoft and pull 0.8?
Well, in my position, certainly to sleep well at night, I'd rather take Microsoft.
Exactly. And so, next question is there reason to diversify pretty much the same income between the SPY and Microsoft? And I would say sure, that definitely makes sense. The SPY only has 5% holding Microsoft. So I think that's a very smart way to diversify your capital, and think that's a smart move from my point of view. Now,
I guess in your example there, and that 90 grand, I was looking for it to diversify into a few of those stocks, but eliminating the banks and Facebook, and kind of see what that looked like.
okay, sure. Yeah, let's do that. Easy. Now, do you want to still keep some Microsoft? Let's do 10 for now.
Yeah, I want to keep Microsoft as well. It was just eliminating the banks and Facebook in this example.
Okay.
On the 90 grand, just to see what that would look like.
How's that look?
Yeah, that's
Something like that makes sense to you?
Yeah.
So yeah, so that's important. If you don't like a specific company or a certain sector that's in our palette, you can change it. It's designed to fit your goals and your needs. I'm here to teach you how it works and give you the general idea, but certainly there's no one fit wonder for everyone. So sure, yeah, people are hating on Facebook right now, and if you don't want to own Facebook, don't own Facebook.
Yeah, it just that company. I mean, it's not that I don't like it, or actually,
You're not going to vote Mark Zuckerberg for president?
Absolutely not. But yeah, it's just so much going on there that I kind of would like to just stay out of that.
Yeah, you don't want a Zuckerberg, spying on you. I
Well,
understand.
I just, there's so much political stuff going on with that too, in
Yeah,
regards to
certainly. And
that.
so, if our audience typically isn't above $1 million, most of our folks are between 50 and 1 million. So if I was to redesign this for a little bit richer investor, we wouldn't be playing with Facebook. We would be dealing with Google and Amazon in there.
Yeah.
But 100 shares of that, you're talking 150 to 200K just to ante into the poker game there.
Right. No, I like this diversification within it. I was wondering in looking at that, what your thoughts were on AT&T.
Yeah, so
I just like the
that's a
yield on
huge
it.
company, and that could, arguably have a position in this portfolio. And gosh, I spent a ton of money with AT&T. So the stocks I chose for the high yield are all tech, obviously, and the safety play was the banks. So are we missing out on telecommunication, oil, energy? Sure. So these are products I personally use that I enjoy studying inside out and tracking and being able to help predict it. So being a 33-year-old who loves technology, this palette made more sense for me. Now, could I reorganize it and look at some other sectors? Sure. Yeah, we could go to the SPY ETF and do the same mindset and look at some of the other top holdings. So certainly I did handpick these, and based on things that I feel like I would enjoy studying in depth and really staying on top of. And plus, the tech companies have the best yield, and they're the ones who are disrupting industries for the most part. So when we look into the future, although they seem more volatile and risky now, perhaps when you look down the road, the big tech companies perhaps are going to disrupt some of these older school dinosaur companies. And so that's one reason I did choose this specific lineup.
I see.
But yeah, I like AT&T, and it'd be a great company to write covered calls on.
Okay. Cool. Thanks, Jason.
Yeah, of course. Okay, wait, we got some more questions popping in here. Mark likes to combine he thinks joining the emerging markets with the SPY makes a lot of sense. And yeah, certainly it does, but some people don't want to support communist China. A lot of people don't like the Russians. India's got fraud left and right, but they've got 1 billion people and the population's growing rapidly. South Korea is the hub of the world for creating all the microchips. So there's good reason if you're not making an ethical decision to stay out of emerging markets. You look at population growth, you look at the rising income levels in China and India particularly. That's when you'll understand this is probably the future outperformer. Maybe it's not in this 5 to 10 years, but in the long run, most likely the American economy is relatively going to stabilize and grow at a good pace. We're not going to look back and regret it. But if we look into the future, there's a lot more room to grow when we go over to Asia. And they're building a huge, if they can stop fighting with each other and really come together, they have a lot more people to sell products to in a shorter amount of space. So it's going to be a huge economic boom. America did well. We were, hanging out on our own island. We had no competition. We had a huge population. We got to get rich from the world wars, collect everybody's gold, and create the best laws, the best government, and the best technology companies. So I'm not anti-American at all, but definitely if you're not opening your eyes to emerging markets, You know, you're the ostrich with your head stuck in the sand, and that's just that. How about the XL sector funds? So let me pull up the high yield. I like Bank of America, Wells Fargo. That's after Apple, that's the two biggest positions, and Warren Buffett's Berkshire Hathaway. We know the central bank will bail out Bank of America if it gets in trouble, and that's why this is such a smart move for retirement income. And they also just took a beating, so they are trading cheap right now. Not that we're trying to pick sectors or anything like that. You know, it's all a big, how can we lower our risk and make our returns more consistent? Jeff Woods says, will we collect dividends and add it into our returns? Yep. I'll likely account for that in the stock trade portion. So certainly we don't want to get assigned out of our shares right when we're going to get a nice dividend payout. So that's another thing we'll keep an eye on. I mean, the SPY ETF has a nice dividend in itself, so certainly not going to turn down dividends. It's been a lot of fun chatting with you guys. Any last questions before I wrap it up and start to prepare for our emerging markets class tomorrow?
Just one question. What do you think would be better, Verizon or AT&T?
AT&T.
Okay. Thank you.
Yep.
Thanks for your time, man. This has been great. Appreciate it, Jason.
Hey, thanks for being my #1 participant. And if there's no other questions, I will look forward to hanging out with you guys tomorrow.
You got it.
Sounds good.
Take care, Jason.
All right, talk to you guys later. Thank you so much. I really appreciate your time, and we'll have a new update for you in the morning.
Thank you. Have a good day.
Thank you.